Imagine what it's going to do to some of the miners. Now, the silver's in a unique position fundamentally because its primary production doesn't come from the silver miners.
No.
And therefore, when its price goes up, it doesn't entice a massive inflow of new production. Right. Why? Because most of the mining comes from lead and zinc. And the miners who get that stuff out of the ground aren't primarily focused on the tertiary market that they're also bringing silver out of the ground. It doesn't cause them to go mine more heavily and aggressively just to get the silver because it's a minor portion of their output. You get the point. So it's got a unique supply-demand situation as well, but we don't get into that. That's just a background feature. And I just think silver's going to reprice itself at $100, $200. And yeah, you're going to get sell-offs from there, but you ain't coming back to 50 or 20 or 30 or anything like that. You're going to be in a new reality. Silver's going to be living at a level that just has been living in the last 50 years, between 50 and 10. It's going to be a new level it's going to be living at. And I suspect it's going to be like 100 to 200 somewhere. The key is to catch that move. And I do not think it will be incremental. This happened in 2000 and also 2007, where you made a high. In fact, we turned bearish in January 2000. And the market made a new high in March, marginally. Pull back again, went up, made another new high monthly close in August. It didn't really start to fall apart till 2001. And this is a year after momentum said, you're no good. And sure enough, if you got out of the market in January, yeah, you missed another 5, 6, 7, 8% of laborious BS action, up, down distribution. And then you had a collapse that, killed you. Same in 2007. We got to a target zone minimally in May, had a sharp pullback into the summer. And again, in late 2007, in September, the Fed cut rates finally. Okay? That caused the final rally that lasted into mid-October. Lasted for a month, buying the cut news. That was the top. What did it do? Silver took out the all-time highs. The May high of 2007, which was what? 1550. What was the high in 2000? 1550. A dual top was broken through because the Fed cut rates in September 2007, laborious topping action in 2007, because of a Fed rate cut. Why? Because they knew the mortgage crisis was coming, although they denied it. And the market partied, and that was the top, a triple top price breakout. 1550, 1550, then in October, 1575 of 2007 was the top. So it's laborious. We're going through the same thing right now. The problem is, from a momentum perspective, if you get the chart and look at it, price has punched out the January high on the S&P or the February high, and momentum has not. When you look at the momentum chart, you say, ooh, it's up under the structure that it broke. So if the bottom chart were a price chart, you'd be wanting to sell. The price chart looks like I'm going to go up forever. The momentum chart says, no, you're not. We have a debate here. This is what often happens technically when you're at the top. Momentum will break down first, price will break down second. Momentum usually tells you ahead of time. Right now, momentum has already told us, don't trust the new highs. They're likely not sustainable. And that when that money flows out of there, that's further fuel for gold and silver. I think you just got to be, if you're in the stock market, and that's the only thing makes people smile right now, the average middle-class guy or guy's got a retirement account, he's a retired government employee, hey, at least my 401k and my retirement account's up on the year. It's not up much, by the way, but, it's up on the year, and it's going to go forever because I could just tell, because NVIDIA's up there, right? You're going to watch the financial sector. When that goes down, there's nothing to smile about anymore. I mean, we know the consumer credit problem is a crisis level. The defaults on credit cards, the credit cards being maxed out, delayed delinquencies on tax filings, all kinds of metrics like that. Unemployment, you mentioned this, earlier. All these things don't look good. Yeah, my retirement account looks good. You take that away from people, and suddenly you have emotion. And when you get emotion, all kinds of things change. And I think we're on the cusp of having serious emotion, not just because of the stock market, but because of certain other points of uncertainty, like expectations that, commodities are going to stay low and oil's going to stay low. Don't count on it. Oil's got a trigger above it about a handful of dollars this quarter above where you are right now. You better not go back up into the high 60s again, because if you do, it's going to explode. And that'll be hard to explain for some people, because they thought, I thought we was going to keep it down. Uncertainty is the key issue, because that creates emotion. And that's what comes into play, especially at points that we were talking about with the monetary metals when emotion comes into play.
Now, I want to make one thing clear from the start. I'm not talking about some small speculative spike that fades back into the old $20 to $30 corridor. I'm talking about silver finally breaking out of the prison it's been locked in for 50 years and establishing a new normal, somewhere in the range of $100 to $200 an ounce. That's the level where I believe silver will live for the next generation. Why? Because this isn't a normal cycle. This is structural, and the evidence is everywhere. Let's begin with something fundamental. Supply. Silver is in a unique position because unlike copper, gold, or oil, its production doesn't respond well to higher prices. Most people assume if silver goes up, more mines will open, right? Number. That's the trap. Silver is primarily a byproduct metal. Over 70% of all silver mined in the world doesn't come from silver mines. It comes from lead, zinc, and copper mines. Those producers aren't chasing silver, they're chasing their primary metal. So when silver prices rise, those miners don't suddenly decide to dig twice as deep for more silver. It's an afterthought for them. It's like saying, let's grow more apples because bananas are expensive. It doesn't work like that. You can't just switch the machine over. That's why silver has such a unique supply-demand imbalance. It's not elastic. You can have a doubling in price and production barely flinches. And the demand side, it's exploding, both industrial and monetary. Let's talk about the industrial part first. Silver is no longer just a jewelry or photography metal. It's a technology metal. It's in everything that defines modern civilization. Solar panels, EV batteries, semiconductors, medical devices, satellites, and now AI data centers. You've probably heard the line, data is the new oil. Well, if data is the new oil, then silver is the new pipeline, because it's the best conductor of electricity known to man. There's simply nothing that matches it. Every AI chip, every server farm, every renewable grid needs more and more silver, and yet nobody's planning to produce more. It's an unsolvable equation. Rising demand meets capped supply. That's why I say we're not in a normal price cycle, we're in a repricing cycle, and the market doesn't understand it yet. Now let me switch gears to the monetary side, because this is where emotion, and therefore momentum, enters the story. Silver, like gold, is money, but it's also a mirror. It reflects emotion in the system. When people trust the system, silver drifts. When they lose faith in governments, in banks, in currencies, silver erupts. And right now, you can feel that trust eroding everywhere. The average person still believes their 401k is safe because their stocks are up for the year. They look at their retirement account and think, well, Nvidia's doing great, so everything must be fine. But that illusion is thin. Under the surface, consumer credit is cracking, delinquencies are rising, tax filing delays are soaring, and households are leaning on credit cards just to get by. Meanwhile, the financial sector is wobbling. Banks are still sitting on hundreds of billions in unrealized bond losses from the last rate shock. And the government? It's adding $1 trillion in new debt every 100 days. That's not capitalism. That's desperation dressed in a necktie. And the Fed knows it. That's why they'll cut rates again, not because they want to, but because they have to. Now here's where history gets instructive. Think back to the year 2000. Stocks made a marginal new high in March, barely above the January peak. Momentum, however, had already rolled over months earlier. The momentum chart was screaming, "This rally is fake!" But the crowd didn't listen. What happened next? Laborious, messy distribution. Months of up, down motion that looked like strength but was actually exhaustion. Then, the collapse. Same story in 2007. We reached our momentum targets in May, pulled back, then had one last hurrah after the Fed cut rates in September. The crowd bought the Fed pivot narrative. The market made a final, marginal new high in October, and that was the top. The music stopped. In both cases, momentum broke first, price broke second. And what's happening now? Exactly the same thing. Price charts look euphoric. New highs, new headlines, soft landing talk on every channel. But momentum has already broken down. If the momentum chart were the price chart, you'd be selling everything you own. That's the divergence that always marks a top. And when the money flows out of the stock market, it needs a home. Historically, that home is gold and silver.
The background factor as well. But our focus right now is on this trigger point, because in the past, when you look at those two parabolic moves, it's what caused that, okay? What technical signal? Because already silver was in an uptrend, so it's not like it started a bull market then. It had already been in a bull market. What caused it to accelerate is the key. And we think it was this spread relationship caused the flow of money to go into silver, because when it broke out, it woke people up, especially people on the industry side. But silver right now is vastly undervalued historically to where its normal price is, even in a commonplace year. Like I said, 21 of the last 50 years, it's been at least 2%. Didn't even require a bull market most of those times for it to be there. We're at 1.2. Okay, so wake up. You've got a situation here that is pending, and it looks like it's explosive. And it will happen not slowly, but it'll unfold so quickly. Now, you've got to also be aware that in the middle of both of those moves, where we've been up like 5-6 months vertically, there was a 1 month phenomenon of a correction that fooled people. So like after about 3 months of upside gush, you get this month that says, oh golly, I made a top, okay? Don't count on it. Now also there's another issue. Well, where might silver go? When we do a study of the logarithmic percent gain, once that spread broke out, where was silver then? What percent did it gain over that next 6 months? Well, it was different. 79 to 80 was far more on a percent basis than it was in October 2010 to April 2011. But they were both very dramatic, obviously. If we then take those logarithmic moves, not point value, not dollar value, but the percent scale move of each of those swings post the breakout in the spread, how much did silver gain? And you lay them on top of the current chart, it argues that at minimum you're going to see $100 in the next 6 months, and you quite likely could see $200 in the next 6 months. The issue will be, in my view, where are you in that first half of that surge? In other words, if it takes us 3 months just to get up to, let's say, $70 or so, and then you have a correction, then maybe in the next 3 you only go to 100. But if all of a sudden we find that in 3 months, the first half of that move, you reach somewhere around 100, then watch out. There's a potential we could go to a couple hundred. And by the way, in real dollar terms, as I've said, based on the degradation in the money unit, if silver were 200, it'd merely be matching something like that 1980 peak. So, ponder on that.
Yeah.
I think we're sitting on a unique situation here.
You give me a lot to ponder about here, Mike. That was about loss for words.
Yeah.
Is there anything else?
You go to the next page, and I'll show you. I'll show you this chart. Here's the 2008 move, for example. Spread chart is the top one, and it shows the same ceiling type action that prevailed for a couple of years, just like ours has prevailed since 2022, 2023, 2024. The highs were all at that 1.31%. Well, back then it was a different level. It was like 1.6%.
Now let's take this a step deeper, because what I'm describing isn't just another bullish forecast. It's a structural shift in market psychology, and silver is going to be at the center of it. When I say repricing, I don't mean a spike. I mean a redefinition of what silver is worth. The kind of reset that leaves analysts staring at their charts like deer in headlights. It's the same disbelief we saw in 1979, when silver went from $8 to $50 in 6 months, and again in 2010, when it ran from $18 to nearly $50 in under a year. It's violent, fast, and permanent. Silver is unique because it doesn't respond like other commodities. Copper responds to economic growth. Oil responds to geopolitics. Gold responds to fear. Silver responds to everything. It's the most emotionally reactive metal in the market. It feeds on human panic and greed simultaneously. When confidence collapses, people buy it for safety. When industry expands, they buy it for utility. When inflation rises, they buy it as protection. When technology evolves, they buy it for innovation. You can't pigeonhole it. And that's exactly why, when silver reawakens, it doesn't rise. It detonates. Let's start with momentum, because that's my language. Momentum doesn't lie. Price can fool you with spikes, head fakes, and noise, but momentum tells you when energy is building under the surface. Right now, the momentum structure for silver looks identical to what we saw before, both the 1980 and 2011 blow-offs. In both those cycles, silver spent years grinding higher, frustrating traders, trapping speculators, punishing the impatient. Then after everyone gave up, momentum quietly began to rise again, building pressure for the vertical phase. If you plot silver's price on a logarithmic scale, the patterns are eerie. Each vertical run, 1980 and 2011, took about 6 months from ignition to climax. The size of those moves, adjusted for today's dollar, points to a potential range between $100 and $200 per ounce. People say, that sounds crazy. I say, it's mathematics. History has already drawn the map. All we're doing is reading it. And here's the part most people miss. This time, it's not just technicals lining up. It's fundamentals on steroids. Industrial demand for silver is exploding faster than any other period in history. We've already passed the tipping point where industry consumes more silver than investment. Solar alone is devouring over 25% of global annual supply. Electric vehicles, 5G networks, semiconductors, and AI data centers, all of them need silver. And unlike copper or nickel, there's no scalable substitute. You can't replace silver without losing efficiency, conductivity, and performance. Now remember what I said earlier. 70% of silver production comes as a byproduct of mining other metals. That means no matter how high silver prices go, miners won't suddenly flood the market with new supply. A copper miner won't double his output just to get 5% more silver from his ore. It doesn't work like that. So what happens when industrial demand surges and supply can't respond? You get a repricing event. That's what's coming. And the biggest surprise? The institutions are already positioning for it. Quietly, carefully, behind the curtain. You're starting to see fund managers and CIOs, people who used to mock gold and silver, suddenly reallocating. The chief investment officer of Morgan Stanley shifted to a 60-20-20 model, 20% precious metals. Bank of America's Michael Hartnett just proposed a 25-25, 25-25 strategy, including gold. These are not gold bugs. These are Wall Street veterans. They see the same cracks we see. Even more interesting, Harvard's endowment, yes, Harvard, recently disclosed exposure to precious metals. That's monumental. Endowments like that don't make emotional bets. They move strategically, ahead of trends that they know will last decades. And here's the key. Every one of these moves takes liquidity out of paper assets and shifts it into hard assets. That's a big deal because liquidity is the oxygen of modern markets. When it starts flowing into metals instead of stocks or bonds, the old system starts to suffocate. Now let's talk about what happens when that flow accelerates. When the stock market tops, and I think we're close, emotion takes over. That's not an opinion, it's how markets function. Momentum always breaks before price, and right now, that's exactly what's happening. The S&P 500 has pushed above its February highs, but momentum hasn't confirmed the move. In technical terms, we're seeing a divergence. Price says bull market, momentum says last gasp. That divergence is like a siren. It's what we saw in early 2000 and again in late 2007. Both times, the market looked strong right before it collapsed. Both times, the Fed tried to soften the blow by cutting rates. And both times, the Fed's move triggered the final rally. The fake out that fools everyone before the floor drops out. We're repeating that pattern right now. The Fed's preparing to cut again. When they do, the crowd will cheer, the markets will pop, and CNBC will declare victory. But that will be the last gasp, the buying the cut rally. It'll last a month or two, just like in 2007. Then it's over, and when it ends, the money will flee to safety. But this time, safety won't mean bonds. Treasuries have lost their halo. Central banks have been dumping them. The traditional 60-40 portfolio, stocks and bonds, is dying. The new model is 60-20, 20, and the 20 in metals is where the world's liquidity will rush. And this time, it won't just be gold. Why? Because gold is already expensive. It's already the go-to for central banks. Silver, on the other hand, is still the most undervalued monetary metal on the planet. It's gold's younger brother. Smaller, cheaper, faster. When gold starts breaking records, silver goes parabolic. It's like watching a sports car trying to keep up with a jet and somehow managing to fly right past it.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.